Hi, everyone. Welcome back. Thank you for joining us for our panel from BlockFi, Institutional Adoption and Acceleration. The headphones are there for your use, so you can better hear the stage. Today, we have Gustavo Miguel from FTX, Avi Feldman from GoldenTree Asset Management, Wes Tang-Wymer from Room 40, Giles Cowell from BlockFi, and Brian Oliver from BlockFi, who will be our moderator. Thank you. Take it away.
Great, thank you very much, and thanks for everyone for joining us. So I'm Brian Oliver, I'm General Manager of the Institutional Business at BlockFi, and why don't we start just with quick intros about yourself and the firm that you're representing today.
Yeah, I'm Giles Colwell. I run institutional sales for BlockFi out of the US.
Wes Tang-Wymer. I'm a co-founder and partner at Room 40. We're a crossover investment firm focused on crypto.
I'm Avi Felman. I'm the head of digital assets at GoldenTree Asset Management.
Hi, my name is Gustavo Miguel. I help run the global institutional business at FTX.
Great. Great panel today to talk about institutional adoption and acceleration, and we're going to try and cover 4 themes in the 40 minutes we have together. So first is just where are we now? Second will be some of the crossover between crypto and TradFi markets. Third is institutional lending in the crypto markets. And last is sort of where do we go from here and what are we excited about? So on the first topic of where are we now, during the bull run, it seemed like there was a headline a day about institutional adoption, how it was increasing at pace, new entrants to the space, TradFi firms getting into the space. Obviously, the last couple months have been very different, and so just curious for the panel's thoughts on what they're seeing, if it's changed or altered that adoption or that acceleration. Giles, maybe I'll start with you in terms of what you've seen at BlockFi.
Yeah, I mean, I think on that question, I'd point to 3 things that I think have happened actually very recently, which are important in terms of adoption. One is the NASDAQ announcement yesterday, which I think sort of demonstrates that large exchanges beyond the CME are thinking seriously about how they get into the crypto space. Certainly the transaction that we saw Coinbase do more recently with BlackRock, I think is an incredible sign of the desire of BlackRock's clients. There's $1 trillion behind Aladdin. Obviously that's not all going to go into crypto, but even a tiny slice of what's available on Aladdin going into the crypto space, I think just shows that traditional institutional adoption is definitely there. And I think the third thing that is going to be very important is around infrastructure. And I think when we see BNY Mellon start to roll out their crypto custody solution, that will be a very big signal to the market that the infrastructure, the ability to trade, the exchanges, traditional exchanges, are all very much in the crypto space. So I think despite all of the events of this year, which perhaps have slowed down the adoption, I don't think it's changed the adoption. I think it may have slowed it down, but I think certainly some of the biggest players in the market, names that are very, very well known to traditional players, are going to just bring more traditional assets into the space.
Yeah, thanks, Giles. Avi, maybe I'll come to you. Obviously, GoldenTree was in the crypto markets ahead of the last few months. Has it changed or altered how you're approaching the markets or what you're building or the pace at which you're doing it?
Well, the prices are better, so we're doubling down. I'll tell you that much. I mean, it's interesting. If you look back over the last few years, back in 2019 and 2020, the first question that anybody would ever ask me was, how do I buy crypto? I don't get that question so much anymore. Now people are asking me, what should I buy in crypto? And so what that tells you is that it's become a lot easier for both your average person and your institution to actually come in and buy crypto. Firsthand on their balance sheet through a dedicated fund. They can link up with people like BlockFi, they can link up with people like Coinbase, with all these other providers that allow you to access the market, and that didn't really exist as much 3 years ago, and the people that were around 3 years ago, you didn't really trust them because they'd been around for 6 months, right? So now that we actually have a track record of brokers that are able to provide that service that haven't necessarily gone under, some of them have, a lot of them haven't, and you have a little bit more history in crypto, that's actually made it a lot easier for institutions like GoldenTree to come in and actually put on a trade. So GoldenTree figured this out actually in mid-2021 when the futures curve was massively dislocated from the spot market, and they tried to put on the trade and they found it a lot easier than they expected. They thought that the crypto market, and I wasn't there at the time, but they thought that the crypto market was the Wild West, and it was very difficult to access, and it would be very difficult to put on a futures trade. And then they found out, wait a second, it's actually pretty easy, and that started a lot of the spiral into the industry. I also think a big point that we can talk about later, but I won't go on too long, is regulation. The clarity around that is is very important for institutions to come in this space, and that has been improving over time as well.
Yeah, great. Thanks, Avi. Wes, you're sort of in a unique position of not just scaling during the crypto winter, but actually launching during crypto winter. Does that change your perspective of how you're approaching your launch, and what the initial first phase of your fund looks like?
Yeah, I would tend to agree with what Giles and Avi have said, right? Which is, for us, and very similar to GoldenTree, the direction of travel, right? Why we decided to enter this space and build a firm focused on crypto is that the 10-year, 20-year view hasn't necessarily changed, right? Prices are a lot more attractive. But in terms of knowing what game you're playing, I think that's something that's really crystallized, right, over the last year. The way that we're set up, we have a dedicated venture strategy, right, where we can take these long-term bets, right, and have a secular view that is expressed through the way that we partner with early-stage founders. And it's a bucket that we don't touch, right? We're in the trenches with folks. We want to build with them. But on the other side, we're coming out of this almost Lehman-esque, right, moment in time within crypto, and it pays to be more tactical, right, and to be more opportunistic around the opportunities that are afforded by the market as it exists today. I don't think that's really changed the institutional adoption curve. I think a lot of folks are now asking questions that they weren't asking, say, October or August last year, which is ultimately a healthy thing for the industry, and I think we'll talk about it later, but regulatory clarity ultimately will be good for the industry as well. So I think for us, it really crystallized exactly what we're doing on each side of the house to ensure that we're focused on the game that we're playing, and that's just better defined now even than when we initially launched in May.
Yeah, great. And Goose, I'll wrap up with you on this question. So institutional clients you're talking to, what's your finger on the pulse? Are people still building like they were pre-crypto winter, or what's the reaction from clients that you're speaking to?
Yeah, Brian, I think that's a great question. Since I joined crypto in 2017, one of the top questions I hear over and over is, when are the institutions coming? During the 2017 bull market, it was still too much of a retail market, retail euphoria. This last bull market, actually I was at Coinbase beforehand, and I saw both at Coinbase and FTX institutions going through this ridiculously long onboarding process. In fact, when I transitioned over to FTX, I was curious if they were seeing the same. And that just stands out to me quite a bit. I'm sure it does to a lot of the other panelists. The amount of effort the institutions have put in to make sure that they don't miss the next bull market. 2017, they were too late. 2020, they were almost there. Now they're very committed to making sure they're prepared for the next bull market. And I would say one thing about institutions is, like, when I first started trading in TradFi, Morgan Stanley prop trading, one of the funniest lines to me was always like, Goose, make sure you buy low, sell high, right? But when you actually, the line is simple, but the execution is very difficult. When you think about buying low, that's when the whole world is like ending, right? You're the only literally buyer, the one that's stepping in at those levels when nobody else is. And when you're selling high, it's when everybody's getting a case of FOMO, right? And you sell and, like, wow, for example, last year, if you sold Ethereum at 4,200 on its way to 4,900, now looking back on it, that was like an incredible sale, right? When you first made that sale at 4,200 and 3 days later it was at 4,900, you probably felt you sold way too soon, and then it might run to 10,000 on you. So what I would say is institutions here are actually going to be playing a very critical role going forward, because the leader right now in the markets overall since December of last year has been the traditional markets, the equity market. Ever since Chairman Jay Powell capitulated on transitory inflation, now all of a sudden crypto narrative isn't at the forefront anymore. It's the traditional finance market. So when my contacts at a Goldman Sachs or a Morgan Stanley or traditional finance hedge fund reach out and they say, Goose, what's going on with the crypto markets? My response right away is, well, you guys got to tell me what's going on in your market, because that's leading right now. And especially now with the merge behind us, Right now as we're speaking, like we're having the FOMC results out there. Chairman Powell's going to talk at 2:30 today, right? Try to guide us going forward. That is so important. As much as like crypto traders love, the Bitcoin charts, ETH charts, ETH BTC ratio, we're going to be taking our cue from the S&P 500 and NASDAQ going forward. So if the traditional markets bottom, I mean, ETH is super interesting to me right now because if you look at the way it's set up overall, it's the ETH merge is the equivalent of 3 BTC halvings, right? And when do you want to own BTC? It's 12 months post the actual halving. That's something you could start to see with ETH right now. And just lastly, to finish on Brian's question here in terms of institutional adoption, even though, let's say, going back to late last year, around October, November, December, when Bitcoin hit 69,000, ETH hit 4,900, since then, it's been a tough crypto bear market, right? And the market's kind of been like somewhat like this. But in terms of institutional adoption, it's been one way. And in fact, there's been some weeks where it's this way because they're so committed to seeing this through. And again, they want to buy low, sell high. So like going to Avi's point, are they going to be doubling down these levels? Absolutely. Like the biggest indirect short in the market, in my opinion, are the institutions. Like they're the ones rooting for Bitcoin to like break 15,000 to the downside, ETH for it to break 1,000, right? Because remember, institutions, they're not putting $1 million, 10 million to work, right? They're putting like 9 figures to work, 10 figures to work. So they can't just have like recently when we saw ETH hit that 880 level and we had seen Bitcoin right now, in that 17,500, 18,000 area, like it's only there for a second. That's not long enough for an institution to accumulate. So I think most of the institutions are in the camp right now, like we're okay for the market to stay low for a little bit of time so they can accumulate those positions, then be well positioned for that next bull market.
Yeah, actually, you bring up an interesting point that I want to hit on, which is a large reason that adoption has actually happened from institutions over the last year. It's not the main reason, but it is actually a very big reason, is that liquidity in both Bitcoin and Ethereum have improved dramatically over the last 2 years, to the point where if you're a hedge fund and you're actually trading actively and you're trying to hedge your book on the weekend and you're trying to pick an instrument to hedge your book with, if you can't hedge part of that book with ETH or BTC, you're actually at a competitive disadvantage to other people that can access that market. And so if good news comes out and you go, okay, I need to get risk on my book, I need to do that right now. If you can't buy Bitcoin, you're actually at a competitive disadvantage right now relative to other hedge funds that can do that. And so that's actually driven a lot of the adoption. A lot of the conversations I have these days are around that dynamic, around the correlation and what breaks that correlation. So we can talk about that another time. That's another big point, is that as liquidity has improved, it's allowed institutions to come into the market in a way that they haven't really been able to before.
Yeah, and I would just add to that really quickly. I think that's a fantastic point, is weekend trading, where traditional markets, as we know, is only Monday through Friday. In fact, like I love the market so much when I started trading prop at Morgan Stanley that I used to say, like, I hate Fridays, love Mondays, right? I definitely got what I was like asking for in the crypto markets, right? You have to be really careful what you ask for. When they say 24/7, they're not kidding. And we saw it earlier this year, like during that initial correction, right? Where when the S&P would close Friday, 4 p.m., everybody would shift over to the crypto markets and would view it as a risk-on leading indicator and be like, okay, where are the S&P futures and NASDAQ futures going to open up on Sunday? And they would take their cue from how crypto trade over the weekend. I thought that was a very powerful sign of institutional adoption.
Yeah, one other point I'd add is, last year when we had sort of, Bitcoin on the highs, a lot of institutional investors, their first step into the crypto space tended to be in VC. And the question I often ask them is like, what's it going to take for you to move into the liquid side of the market? And they just weren't comfortable with Bitcoin on the highs. It was just rallied too fast, too high. But I think now that we are where we are in the market, it represents good value. And I think you're going to start to see people move into the liquid side a lot more than they would have done, in fact, 6 months ago when we were on the highs.
Yeah, great. Thanks, guys. Terrific comments. So I want to switch gears a little bit and talk about actually building. So Wes, I think from your perspective, new fund, need to build infrastructure, technology, connectivity, relationships. Can you give some sense for what that looks like today in terms of, how as a new fund you're getting operationally set up to trade in the markets?
Yeah. Long sort of road, right? We're still, to me, it feels like we're still in the age of LimeWire and like Napster, right? In terms of setting up infrastructure. right? You talked. I've had in a previous life I was in long short equities, and then it's also part of building a big late stage growth practice. And there's such a set playbook, right, of infrastructure. You want to start a new long short equities shop, you prime with one of the big banks. They provide you end-to-end service, right? And you know, everything from custody to execution to margin. It's all exactly sort of cookie cutter off the shelf, you know, soup to nuts, right? And I think one of the big surprises that my partners, Paul and Marissa, and I sort of encountered when we first came into this space is, holy shit. Like, you got to do everything, you know, essentially from scratch, right? And there isn't necessarily a book of best practices. Didn't have Avi on speed dial to guide me through it, right? So I think for us, it was really about ensuring that every part of the stack for us matches up with the background that we have, which is coming from deep institutional experience, right, across private and public markets. And so when you bring on custody, what does that exactly look like? What are the different pieces that you need to have to ensure that you can actually properly, securely, you know, custody your assets, all the way through to liquidity? What are the different venues? What type of counterparty risk are you actually taking on, right? And I think there's been such a change because we launched in May, and so you can imagine we were setting up all of this infrastructure Jan through May, right? And I think in those days, it was a little bit like going through like the Apple terms of service, right? It's like approve, I'll sign here, right? And that was sort of like the overwhelming imperative, right? Within the market that was still, I think, coming off the back of this incredible bull cycle. And for us, being relatively new to the space, didn't kind of make sense, right? And we wanted to replicate some of the practices, the risk discipline that we had coming from our prior backgrounds. And I think that conversation has been a lot easier, you know, obviously post-May, and getting the rest of that, you know, infrastructure set up has been incredibly collaborative with folks, you know, on the panel and otherwise. And so I think we're getting to a point where it's getting a lot more mature, but we're still pretty far from having that end-to-end solution that, you know, you can go and sort of point and click and, you know, we're ready to go, right? But the direction of travel is towards that.
Yeah, Avi, I'm curious to get your perspective from inside GoldenTree, where, you know, all those things that Wes talked about existed for the traditional markets that you participated in. So, you know, the standard was set in terms of in the firm, in terms of what you needed to build to. How did that look when you were setting up the crypto business, or how does that look today as you continue to build out the crypto business vis-a-vis the traditional markets that your firm is excellent at?
It's a really important question, and the answer is that there are places that you can go to get services in piecemeal, but it's like putting together Legos. You have to figure out exactly what you need, exactly what you want, and you have to go find all the pieces, and then you have to go assemble them and put them together. And then sometimes what you'll find is that you're actually missing a few pieces, and you're like, okay, great, I have to go build that out myself. And what I would say is it really starts with what you want to do yourself. So if you just want to go buy Bitcoin and then hold Bitcoin, that's actually a radically different problem and much more easy to solve than I want to go run a long-short hedge fund that trades the top 50 tokens. Huge barrier to entry to the second one, less so to the first one. At this point, if you want to just go buy a token in the top 10 and have that token priced, that's actually not so hard. That's pretty easy. You can do that. A lot of the issues around that when it comes to institutions are that they don't necessarily, it's A, reputational risk, still a little bit of it, and B, it's regulatory risk, and people have different thresholds for risk, right? So at GoldenTree, for example, we're pretty far down that risk curve because we view the risk as generally less than other people might. So we're able to go play in DeFi. We're able to go trade assets on exchanges like FTX. We're able to go trade assets outside of the top 20 because we've made the conscious decision to go build out that infrastructure, to build out that operations, to educate our ops team, to educate our compliance team, to educate our lawyers, to build internal policies, and then to execute on them. All of that is a long and arduous road, but you can get there. And it really depends on your ability to evaluate your own risk when it comes to accessing crypto assets, right? So if you're somebody like a BlackRock, you're generally going to be a lot more conservative across the board than a hedge fund would be, right? If you're a Goldman Sachs, you have regulators breathing down your neck every single hour of every single day, and so you're just less able to do things that somebody else might be able to do. And so really, it just depends on your risk tolerance in many ways. But there are ways to build things out. But I'll give you guys an example of an issue that we ran into in 2017 and 2018 before there were custodial solutions. Let's say you wanted to access a token that was outside of the top 10. And you're like, okay, great. I'm going to go buy it. I'm going to go put it in my MetaMask. And then your LPs come to you and they say, hey, prove to me that you own that asset. And you go, well, I can sign a transaction with this wallet. And they go, what does sign a transaction mean? Right? It's a little difficult. You have to. There's a lot of education that goes into it as well to get people comfortable with it, both internally for us at GoldenTree and externally when we're talking to our LPs and our ops team. So there's a lot of work that goes into it. Today, obviously, you have a lot more resources. You have resources like Fireblocks, like Coinbase Custody, that will you'll be able to sign up for it and put your assets with. But again, there's a lot of regulatory uncertainty. Let's say you want to buy an asset and you can't hold it with what's quote unquote called a qualified custodian. What do? Do you not buy the asset? Do you say that you made best efforts to put it with a qualified custodian, and you go, well, there's no clarity on this, so we made best efforts, so please don't come after us, right? And that just kind of depends on your own risk tolerance. That's not necessarily something that we would do, but it maybe is something that somebody further down the risk curve would do.
One quick question. I think one of the most sort of chewed over trades that most institutional clients spent time with BlockFi talking about was the basis trade. Very easy to understand, pretty much identical to what exists in traditional markets. What do you guys think about that trade coming back? What do you think it will take to actually bring that back? Is it retail coming back into the market? Like, how do you think that will?
You got to ask yourself where the trade came from, and the trade came from the fact that people were willing to pay out the nose for leverage because they thought that Bitcoin would go up 10% the next day, and so they were just like, I want as much leverage as I can possibly get. And the type of person that does that is very much so you're like gambler, right? And so that's really where all the edge was coming from. So the answer is, I think categorically no, that trade is not coming back in the way that it used to be here, because one, there's a lot more cash in the system that's willing to take the other side, and two, leverage across the board in crypto has actually come down pretty substantially when you're looking at retail clients. I think at some point in the future that will come back, and you'll probably see similar levels of leverage taken out on the retail side, but because there's going to be so much offsetting cash that can take the other side of that trade, you're not going to see levels blow out, at least on Bitcoin and ETH. But where you might see it is you might see it downstream, right? And so that's one of the reasons that building out your infrastructure is really important, because the market in crypto changes every 6 months, and you kind of have to be always looking, okay, well, what is a market in 6 months? What is it going to look like? And how can I build out the tools today to capture the value of tomorrow? And so when we look at something like the basis trade, we think to ourselves, well, maybe it's not going to exist on Bitcoin and Ethereum, but maybe it's going to exist down the curve. Maybe it's going to exist on asset 75, on asset 90. And so we have to be there and be ready to take that trade when other people aren't, right? So, but the basis trade itself, the easy money, in my opinion, is for sure over for now.
And I would say that's a really important question too, because the basis trade is what brought a lot of institutions into crypto. For example, if you go back to April 2020 when Bitcoin was, April 2021 when Bitcoin was approaching 65,000, the basis trade for Bitcoin was lined up almost at 40 to 50%. That's unheard of. And that really got the attention of a lot of institutions. And when they started doing their homework on the space, I got so many phone calls on, please, don't crush this basis trade for us, right? Because the issue is it's there, but for a certain amount of liquidity. Once you have many institutions coming in, 40 to 50, all of a sudden it's going to turn into 10 to 15%. But given the yields that you saw in the traditional markets for so many years, which is pretty much zero over a decade, one of the strongest bull markets in history, that still was like a very attractive trade for the institutions. So I think it's something that really indicated, again, like institutional interest, but I totally agree with Avi on this one. I think going forward, we have to manage expectations because with all that liquidity coming in and institutions eyeing that, it's probably not going to line up at the same levels that we've seen in the past.
But I think just building on that, there's one of the reasons why crypto as an asset class is so interesting is that it is nascent, right? The players are still evolving, the infrastructure and the ability to do the same thing on Bitcoin compared to Cosmos is just fundamentally not the same curve, right? You need to have completely different infrastructure as Avi was talking about. And so I think some version of that basis trade will be done on a different pair of assets, right? And so one of the inefficiencies that you see is that there is not this parity, right, between, hey, there's free money out there at 40 to 50%, and everyone sort of rushes in and takes advantage of that and arbitrages away. We're still in this environment where it is a pure market, right? It's about as pure of a market as you can get, absent these inefficiencies that exist, right? Whether it's the nature of the participants, retail versus institutional, the ability to access these various assets. And so, so long as that exists, I think that will be a catalyst for various types of institutions to come in and, get into the game, right? And, certain folks came in with grayscale, right? And others will come in with the basis trade, and yet others will see the yield on Ethereum and figure out an interesting way to play that, right? So it's all about the game that you're playing and whether or not the underlying infrastructure exists for you to be able to take advantage of those opportunities as frictionlessly as possible.
Great. I want to talk a little bit more about this interaction or correlation between crypto markets and traditional markets. And Avi, you made the point that if you're a hedge fund and there's good news over the weekend, you can't buy crypto, you're at a disadvantage. Does it work the other way as well? Does it not? As we gotten to the point now where a crypto-only strategy, or if you're a crypto-native firm, that if you can't trade traditional markets, you've got a blind spot, and vice versa. Are the correlations there that you have to really be multi-asset class to be able to take advantage of opportunities, or is there still a pure crypto strategy that can be played?
I think that it really depends on the type of investing that you're doing. Obviously, if you're investing from an early stage or VC perspective, that's going to be a lot less important to you. But I do think that basically anybody that is investing or trading the liquid markets, it's extremely important to understand what's happening in the world of macro. And then even on the long time frames for the early stage guys, right? Like if you had some level of understanding of macro or understanding of what the Fed was doing, you probably weren't deploying your entire fund in January of 2022. And if you did, it probably means that you weren't paying attention. And so I do think that it is really important for people that are solely focused on crypto, unless you're just building the tech. If you're trying to invest and you're trying to trade, you do have to at least pay some attention to it. And I do think that you're at a disadvantage if you can't understand what's going on, because the reality is that if the risk markets are down and people don't feel wealthy, then people aren't going to allocate to crypto. Crypto is so far down the risk curve that it's very unlikely to me that if people fear an oncoming recession or people fear, looking at their bank account and seeing that money being inflated away, they're going to take that money and they're going to put it into crypto anytime soon. I actually don't necessarily think that's the case. So I do think that it's very important. And once the risk markets start to turn a little bit, I very much so believe that crypto will be the fastest horse out the bottom, and it will rebound extremely, extremely quickly. But you do have to pay attention, right? And especially if you're trading on low time frames, you have to pay very close attention, because sometimes these things just trade tick for tick with each other. And so that's actually an area where you can take advantage of the correlation. If you really want to get really into the weeds about it, you can trade that correlation, because a lot of times there's a lag between the crypto assets and the traditional markets. Not necessarily in Bitcoin or ETH, but in some of the other assets, there's often a lag. And so if you want to start trading that's actually a pretty interesting strategy to get into. But I'll save that for another time.
Yeah, I think those are great points, Avi. What I would say too is the strongest correlation you've seen between crypto and the traditional markets is the Fed's balance sheet. If you look at the Fed's balance sheet post-financial crisis 2009, it was less than $1 trillion. Towards the highs a year ago, it reached nearly $9 trillion. And we had interest rates at zero. Like if you just plot those correlations to get Bitcoin, that really was the birth of the crypto markets in the institutional markets overall. But I can't emphasize enough, the game changed when Chairman Powell last year capitulated on transitory inflation. Now we're going the other way, right? So and now we're all of a sudden going to take a $9 trillion balance sheet and we're trying to unwind it, which by the way, they really just started now at a rate of about $90 billion per month. It's hitting the market. So take a second to think about that and really digest that, right? The biggest buyer in the market by far has been the Fed, and we've seen that with their Fed balance sheet expanding. They're not just only going to remove that bid, but now they're going to turn into like the biggest seller in the market overall, right? And as Avi said, that's absolutely right. Like once the traditional markets like bottom out, what you're going to want to own is crypto because crypto is a risk-on leading indicator. But right now we're going in that other direction overall, which again is like why you have to pay so much attention to traditional markets. And I love to trade contra indicators. So one thing that I saw December of last year was like, wow, there was so much complacency towards it, and like, you know, crypto is an uncorrelated asset, which I actually do believe one day it will be. And if things get ugly enough, like it might even happen sooner than expected, but it was way too early for it to be uncorrelated. But then all of a sudden you fast forward to the bear market rally we had a few months ago, and it was right when every crypto retail trader became an expert on the Fed and was analyzing the FOMC meeting more than like my fellow Morgan Stanley prop traders were, right? So you kind of see it like work in both directions, but I think correlations right now are the strongest we've seen. And as much as we want to say Bitcoin's digital gold, like God willing, one day it will be digital gold and it will have those narratives that we've been saying for the last few years. But right now it trades a lot more like a small cap NASDAQ stock, and that's Bitcoin, which is the most conservative crypto as we all know. But it also trades a lot like a very risky emerging market currency. So I think now is going to be one of those opportunities where you have to be very opportunistic and you have to pick your spots really carefully, but you have to really be looking at traditional markets to take the cue from there because the correlations are the highest I've seen since I've started trading crypto.
Yeah, you don't want to go all in while the traditional markets look terrible. I do want to play devil's advocate to myself for about 1 second here, which is that if you look at crypto, you can kind of treat it in two different ways. You can treat it, Bitcoin is this macro asset now, basically has reached, you can make arguments that it's reached, you know, close to peak adoption for what it's gonna get adopted for. And then you have all the other assets in the world that are actually, you can treat them more as early stage tech, in my opinion. And so what you actually can look at is you can look at the user growth and usage of these platforms, and there will be platforms that decorrelate from the broader macro markets if they can prove that they can grow into these valuations and actually attract users on a grand scale. So, you know, one example of this is if institutions like us start settling mortgages or loans or credit or debt on chain, and we do it on a specific chain, and then that chain starts to garner a tremendous amount of volume and a tremendous amount of usage, then that product itself can very much so decouple from the macro markets because it has this idiosyncratic flow that's coming into it from real usage. And I do think over the next 2 years, you are going to see specific assets in crypto get real usage and therefore decouple from the macro markets. But something like a Bitcoin or Ethereum, where liquidity is very tied to traditional markets, are probably going to trade in lockstep for a very long period of time, in my opinion.
Yeah, great, interesting. Let's, for the time we have left, why don't we switch gears to lending? So obviously hot topic given the last few months, CeFi versus DeFi. Wes, maybe as you're thinking about setting up the fund and in providing or finding providers of liquidity and borrowed assets, how do you think about CeFi versus DeFi in terms of your strategies?
Yeah, I mean, I think there's a near-term landscape of what that looks like, and then there's the longer-term vision, right? And near-term, for a firm like ours, we seek liquidity and yield opportunities across both on-chain and off-chain venues, right? And so in a period when we've seen this contraction, right, and some of the big players that were traditionally in the off-chain space really get a lot more conservative, then we also have to look at what is available in the on-chain venues, right? And a lot of that really comes down to risk management and whether or not, on the lending side, on the yield side, you're getting compensated, right, for taking on that incremental level of risk, because there's a risk premium, right, to when treasuries are pushing 3%. you want to, that's your baseline, right? And right now, if you look on chain for most stablecoins, it's nowhere close to that because there's no demand for speculative leverage, right? And so you're not getting compensated for the smart contract risk that you will be taking on, right? And so we think a lot about what's the right risk reward on the yield side for participating in those domains. And then on the other side of it, right, as we look for avenues of liquidity, same thing, right? Does it make sense? Are we thinking thoughtfully around counterparty risk, and it could be a off-chain counterparty, or it could be thinking about the appropriate setup and the nature and the risk to our collateral when we're going on to DeFi venues to tap that liquidity. On a long enough time horizon, I think those things will converge a lot more than we see today. Obviously, DeFi isn't exactly panacea, right? Like it's not like it's the most efficient thing. It's certainly not capital efficient by any stretch of the imagination. And we want to see more of the elements of underwriting that exist, off-chain, frankly, migrate on-chain, right? And I think that's an ongoing thing that on the early stage side we look a lot at ways that could be incorporated on-chain over time. But as it stands today, I don't think that that there's an emergent near-term sort of solution to ensure that you can have efficient capital and adequate liquidity that flows both on-chain and off-chain frictionlessly.
The other hot topic in the lending space is obviously secured versus unsecured, or collateralized versus uncollateralized. Giles, maybe you can speak to that from your perspective.
Yeah, I mean, I think that not all collateralized loans are safe and not all uncollateralized loans are dangerous. I think if you look at the events of this year, certainly the loans where money was lost often were collateralized. So it's well documented that Three Arrows had a lot of extensions of credit to them that was collateralized, and some people lost money. Some people were uncollateralized on those loans, obviously lost a lot of money. I think if you look at Terra Luna, you can say that was a collateralized product, which lost an awful lot of money. So I think that kind of to Wes's point, we're going back to fundamental principles around credit underwriting, counterparty underwriting, and I think collateralization obviously is, for the most part, helpful, but I don't think it's everything. I don't think it's a panacea, and I think that there's room for both.
Great. We have a few minutes left. I think I'd like to go down the panel and just talk about what's next, or what you're excited about, or where do you see in the next 3 to 6 months in terms of that would really change your business or be helpful, or so I'll start down there with you, Goose, and come down back to Giles.
Thanks, Brian. I would say for the next 3 to 6 months, what excites me the most is the options business. At the Crypto Bahamas, one of the favorite stats that I heard that day was if you look at traditional equities market, when you see options notional volume versus spot, it's 30 times as big. When you look at crypto, options is only 3% the amount of spot traded. I think that tells you what the future growth is, and that's what's going to really unlock the institutional participation, is once you have a very liquid options market where you can strip out that macro systematic risk and isolate that alpha. That's something that we're positioning ourselves for, we're really excited about, and when we see that liquidity in that options market, we really believe that's going to unlock a lot of institutional participation.
Yeah, my view is that basically up until now, we've had a bunch of incredible experimentation in crypto and a few products that have been used widely, but really by a small group of people that just happen to have a lot of capital. Over the next 6 to 12 months, I'm fairly confident that what we're going to see is we're going to see broad-based products that are taken up by a lot of people and used in ways that we can't really honestly imagine right now. And I say this because scaling on blockchains is coming to a point where in 12 months, we're going to be able to run through on stable platforms tens of thousands more transactions per second, hundreds of thousands more transactions per second than we do currently, based on the way that current research is going, especially with ZK rollups. So I see this as blowing open the field for a variety of new types of products coming through the pipeline, and I'm super excited to see what they are and start investing in them.
Yeah, I think for us, one of the guiding principles is we just follow where the talent goes, right? Where the builders are building. And there's usually a bit of a lag between when the builders are, hard at work, sleeping in the office, and when that product is actually in our hands, right? And we're about to see that, right? All of the work that has been done, all of the talent that has flowed into the ecosystem, undeniable and just incredible to see. And so, very much to Avi's point, a lot of what we're going to see in the coming, months is the fruits of those labors across domains, ranging from DeFi and fintech, right, and how those converge all the way through to commerce, through to identity, and all of these other areas. So we're really excited about seeing some of those things, launch into mass market adoption, which is going to be sort of that next wave that we're super excited about. And capital takes on a new role in this market compared to traditional venture and technology investing, and we can be active participants in that, and we're super excited about it.
Yeah, I think I'll just make one last point. I think when I look at projects across the ecosystem, to use a sort of anonym, I'd say, the USA is sort of utility, scalability, and adoption are going to be a lot more focused on by investors. And I think, everything was awesome was kind of where we were sort of 3 to 6 months ago, and obviously it wasn't. So I think we'll see a lot more of that. And I think the final piece of that is going to be safety. So I think those sort of 4 kind of metrics are going to be much more focused on. And I think one of the things I would say is just sort of going back to my earlier point kind of around safety. We did a piece on blog posts on collateralization today, which I do sort of encourage people to go and have a look at. But I think we're in a sort of, we've been through a sort of cathartic period. So I think for me going forward, to the panel's kind of view, it'd be interesting to see, what gets built going forward. I think this is a time of building, and I think we're going to see a lot of exciting products coming out of the crypto space.
Yeah, following on that, I think, I guess what excites me the most is when you've been through this period of turmoil and dislocation that you see things that you perhaps didn't know existed in terms of business practices, risk practices, et cetera. And now's the time to solve for those and lock in those gains. Like take those lessons learned, improve the system. And I think that's what I'm excited to see over the next 3 to 6 months is how the industry responds to what has been sort of a interesting few months and learns from those lessons and builds innovative and creative solutions to reduce some of those impacts that we saw over the last few months. So we're out of time. It's been a great panel. Thank you very much for participating. Really appreciate it. Thank you again.
Thanks, Brian.
Thank you. Thank you, everybody.